Hello friends, I hope you are doing very well today. So grab your pad and your pen and let's get started. Today's lecture is on Forex quotes. First, let's define what a quote is according to Webster Dictionary. So a quote is to state the current price, bid offer spread for a commodity, stock or bond. So a quote is to state the price, the current price for a commodity, a stock or a bond. A forex quote tells you the current exchange rate between two currencies, basically, how much one currency is worth in another. So a quote is what you are giving. I think the word quote is famously or popularly used in the insurance industry. So you want to do some like life insurance, you put your age, the job you do, you put a basic questions, and then you then request a quote. The quote is just going to give you an idea of the premium you pay and all of that. So the quote is the price, the current pricing for a certain thing. That's what a quote is. The first quote tells you the current exchange rate between two currencies, basically how much one currency is worth in another. So when we say Euro USD is $1.5, that is the quote of the currency. That's so if you're asked to quote Euro USD, it's basically asking what's the current price of Euro USD. So every pair, like Euro USD, shows two numbers. The first currency, Euro, is the base currency, the one you are buying or selling. The second currency is the quote currency, the one you are using to measure the value. So if you remember the the definition of what the two currency pairs are. The one on the left is the base currency, the one on the right is the quote currency. So it is in the value or the currency of the quote currency that we quote the price of the main currency. The main currency, the base currency is always one. The quote currency is the one in which value we quote the base currency. So that's what a quote is. A quote is basically the current price of a commodity. Usually in the quotes, in the quote base and quote currency, usually in the quote currency of the currency pair, right? So for instance, Euro USD is equals to 1.1050. So it means 1 euro, again, the base is equals to 1.1050 US dollars, which is the quote currency. So if USD NGN is 1,477, it means 1 USD. In this case, USD is the base, equals to 1,477 Nigerian naira, which is the quote currency in this regard. So let's talk about bid and ask prices. So when you open your trading platform, you always see two prices for every pair, the bid and the ask. So the bid price is the price at which you can sell the base currency. You sell at bid price. The ask price is the price at which you can buy the base currency. So you buy at the ask, saying, and remember, it's like when you ask for something, you are trying to buy. So if you remember that ask price is for buy, instantly you know that the bid is for sell. So let's just break this down. So the bid price is the price you sell the base currency. So the bid price is usually always lower than the ask price, because I think this is also a general thing. When you go to any exchange, even the banks, it's usually two currencies, the bid and the ask. So this is just the fees or the profit margin that is within this currency. So the difference between the bid and the ask is how money exchangers generate their profit. So if currently if USD to naira is 1,400, that's just a round number for it. Usually when you want to exchange, you can see it's 1,390 for the bid price and maybe 1,410 for the ask price. So there's always going to be a difference, because the difference between the bid and the ask price is usually how money exchangers make their money. So for instance, Euro USD would now be quoted in this case of describing the bid and the ask price. It will be quoted as 1.1050 forward slash 1.1052. So in this case, you now realize that there is a difference of 2 pip. Going back to the pip is the fourth decimal place. So there's a difference of 2 pip between the bid and the ask price. So the bid price, which is the sell price, is 1.1050. Usually you sell at a lower price and you buy at an higher price. And the ask price is 1.1052, which is the ask price. So the difference is 0.0002. Now, that is 2 pips. So that is called the spread. Now, the difference between the bid and the ask price is called the spread. So the spread, just think about it like the spread is the distance between the buying and the selling value. So uh, any disparity that there is in the value of anything, like, you can understand it like any disparity, any difference in price. So for instance, you want to buy say you want to buy chocolate, some Cadbury chocolate, standard dark chocolate at a certain store A. So store A sells it at $10, and then you go to another store B sells it at $11. That $1 difference is the spread between those two stores. That is the difference in price. So basically, the difference in price of the current buying and selling value is what you call a spread. Now, if USD NGN is 1,477 forward slash 1,480, so the bid price is 1,477, the ask price is 1,480. So 3 naira is the spread in this regard. 3 naira is the difference between the buy and the sell price. So factors that affect the spread. The spread isn't always fixed. It changes based on market conditions. So let's look at some market conditions. So high liquidity, active sessions like New York and London, the spreads are usually tighter, which means there's less spread. Now, the reason is there is more liquidity, there is more transaction. So money exchangers and liquidity providers and brokers and now in this case they can make money from the sheer volume of transaction that is happening. Going back to the example of the money exchangers I used prior, if you don't have a lot of liquidity, that is, not many people are exchanging your currency to another currency, the few who are exchanging usually pay premium. The difference between the buying and the selling price would be quite high because there is not much people exchanging. So the people who are these money exchangers, they have to make money. So now, if there's not a lot of people exchanging a certain currency to another, first thing is there would be very little competition amongst the money exchangers because there is not a lot of customers. So if there's very little competition, there would naturally be a sort of monopolistic market. So the few who are exchanging now have to make money by charging their clients, in this case, a premium. They'll charge them a higher fee. So, but when you have a lot of people coming to exchange a certain currency to another, a lot, naturally, there's going to be more demand than supply. That's just basic economics. So naturally, once there's a lot of demand and there is supply, business opportunities would naturally spring up. So you see a lot of people wanting to do because one supplier or one business cannot solve all this problem now. So you will see a lot of other people trying to compete. Now, when there is a lot of competition or there's a lot of volume coming into a certain market, a lot of liquidity, naturally there will be competition. And when there's competition, there will be price reduction, there will be price squeezing because business A wants you to come to them because they are competing with business B, so they'll reduce their price a little bit. So that's what happens when there is high liquidity. So liquidity is when there's a lot of money in the market, when there's a lot of demand for something, spreads will be tighter, the fees are tighter. Liquidity is, when people demand a certain product, bottled water, for instance. It is very I mean, today we have premium bottled water, but naturally you would see a lot of companies making bottled water and prices are technically the same. So that's what liquidity is because people are buying in volume. So naturally, the companies don't have to inflate the price of water to make money. They can just make it from the sheer amount of people of volume. Little profit in thousands and millions of sales every quarter, every month covers the cost. So low liquidity, Asian sessions or holidays, they are usually wider because again, there's less participants. So high volatility news releases, wider spread temporarily. And this is because during high volatility, the smart money liquidity providers, they take their money out of the markets. There's an uncertainty in the markets during news. So this is why it's also encouraged not to trade news. You may trade it, you may play with it, try it out, see what it's like, if it's for you, if it's not. But it's generally advised not to, because the smart money or the informed traders, they take their money out of the market and watch. So there are types of brokers. There are ECM brokers. The ECM brokers usually have tighter spreads, and then we have the STP brokers or standard brokers. They have wider spreads. So the definition of this would be explained later. So yeah, I hope this is insightful. If you have any questions, if you have any ideas, shoot them to me. I will be ready to answer you. And yes, I hope you have a great time. Until the next lecture, I wish you all peace and good luck.